Jason Bond from the Boole Microcap Fund. What is value investing? In a nutshell, value investing is buying shares of stock at a stock price that is far below the intrinsic value of the business. Anytime you buy stock, you're becoming a part owner of the business. You own a piece of the assets of the business. You own a piece of the sales and a piece of the earnings of the business. Every business has an intrinsic value or a fair price, and that is what the business is worth. Although it is an estimate, every business does have an intrinsic value. Intrinsic value can be estimated with two basic methods. First, by book value, which is assets minus liabilities, and secondly, by discounted cash flow, or DCF value, which is estimating future cash flows and discounting those cash flows back to the present. For example, if you were going to buy a local laundromat, you would look at the book value, the total assets minus the total liabilities. You would also look at the current cash flows, and you would try to estimate future cash flows. Let's take an example from the stock market. Genco Shipping, ticker GNK. Genco Shipping is a dry bulk shipper. It has a dividend yield of 13.3%. It also has low debt and high insider ownership. In other words, it meets many of the criteria for investment of my fund, and so my fund owns a position in Genco Shipping. First, let's look at the book value. The total assets of Genco Shipping are $1,174,000,000. The total liabilities are $206 million. So the book value, total assets minus total liabilities, comes to $968 million. The market cap, market capitalization, which is the total number of shares outstanding times the share price, for Genco Shipping is $833 million. This represents the total value that the stock market is placing on the business. In this case, the stock market value, $833 million, is below the book value of $968 million. So this may look like an investment opportunity. However, $833 million is not that far below $968 million, so it doesn't look like a super compelling investment opportunity based on book value at least. Let's now look at discounted cash flows. When you look at future cash flows of a business, you have to discount those cash flows back to the present in order to figure out intrinsic value. The reason you have to discount future cash flows is that the farther in the future a cash flow is, the more uncertainty there is around receiving that exact amount. In the case of Genco Shipping, I estimate normalized cash flows to be around $180 million. Using a 10% discount rate, we get an intrinsic value of $1,800,000,000. This is about 115% higher than the current market cap of $833 million. So this does look like an investment opportunity from the point of view of discounted cash flows. Something to keep in mind about market prices is that they fluctuate widely. Sometimes the market price of a stock will be far above the intrinsic value of the underlying business. At other times, the stock market price will be far below the intrinsic value of the underlying business. But over time, the stock price always goes back to intrinsic value. Ben Graham, the father of value investing, used an analogy to understand market prices. He said to imagine you have a business partner named Mr. Market. Every day Mr. Market will come and name a price for the business, and you can either sell to Mr. Market at that price, or buy from Mr. Market at that price, or do nothing. The thing is that Mr. Market is manic depressive and he has wide emotional mood swings. Sometimes Mr. Market will name a very high price. In that case, you would be wise to sell your stake to Mr. Market at that high price. Other times Mr. Market names an absurdly low price. In that case, you would be wise to buy Mr. Market's stake from him at that price. At other times, Mr. Market names prices in between the extremes. In those cases, you just ignore Mr. Market's quote and stay focused on the operating results of the business that you partially own. Graham says investing in public stocks is just the same. If the price is wildly high, you'd be wise to sell. If the price is absurdly low, you'd be wise to buy. Most of the time, you just ignore market prices and stay focused on the operating results of the business that you partially own. Graham said the three most important words in investing are margin of safety. Margin of safety means that even in the worst case, you are unlikely to lose much on your investment. For example, in the case of Genco Shipping, the company could liquidate by selling all of its ships and paying off its liabilities, and you would get something close to $968 million, which is above the current market price of $833 million. So even in the worst case, if Genco were to liquidate, if you invested at today's prices, you'd be unlikely to lose much money. The reason margin of safety is so important is that it's essential to avoid big losses in order to be successful as a long-term value investor. The reason it's essential to avoid big losses is that they're so hard to come back from. If you lose 50%, you then have to make 100% just to break even. If you lose 80%, you then have to make 400% just to break even. After the stock bubble in 1999 to 2000, the NASDAQ declined more than 80%. So this kind of thing can happen. That's why it's essential to be successful as a long-term value investor to always have a margin of safety for every investment that you make. You want to look down before you look up. Warren Buffett was Ben Graham's best student, and Warren Buffett is the most famous practitioner of value investing. During many different years over the last few decades, Warren Buffett has been the wealthiest man in the world. When Buffett started out, he was investing in stocks that were trading well below book value. Most of these companies were tiny microcap companies. Buffett called these investments cigar butts because it's like finding a cigar butt on the street corner. It may be soggy and kind of repulsive, but you get one free puff. From an investor's point of view, that puff is all profit. As a matter of fact, Buffett was actually getting close to 50% per year returns on these microcap cigar butts. However, as Buffett's investable assets grew larger, it became difficult to find enough cigar butts. And Buffett also realized that by buying a higher quality company, he could make fewer decisions and he could have a longer runway of compounding. Buffett made this realization partly through the influence of his business partner, Charlie Munger. Munger said, "It's better to buy a wonderful business at a fair price than a fair business at a wonderful price." If you pay a fair price for a high quality business, then you can get a lot of compounding over time. And here's why. A high quality business has a high return on invested capital of 20%, 30%, 40%, 50%, sometimes 60%, and sometimes even over 100%. If you pay a relatively fair price for a business that has a high return on invested capital like this, and the business can maintain its high return on invested capital, then over time, as you hold your ownership position in the business, your stake will tend to compound at that high return on invested capital. If you liked this video, please hit like or subscribe. Thank you.